Hi, welcome. I'm Amy and I'm here to do an e-tutorial of exercise 9-20 on page 292 of the Pearson workbook. There's a note at the top there in case you don't have volume 1 of the workbook, but we're going to jump right in. Um, if you've watched my videos before, you know that I like to look at the requirements first to see what's being asked before we work through the question. So we'll start there. In this question, there's 5 requirements. The first one the company wants us to use the allowance method to estimate bad debts. In doing so, they want us to use 3 different approaches. So that's where the ABC comes in. First, a percent of sales method. Second, a percent of receivables. And then lastly, they want us to estimate bad debts using the aged accounts receivable listing. Requirements 2 and 3 are both journal entry requirements. They want us to record the bad debt expense following the percent of sales method that we did in 1A. As well, they want us to write off one of our customer accounts. So journal entry to record a write-off. The fourth requirement is they want us to set up T accounts for accounts receivable and allowance for doubtful accounts, and then post the previous entries from requirement 2 and 3 into those T accounts. And the final requirement is they want us to show how net accounts receivable would be presented on the face of the balance sheet. So we're going to work through those 5 requirements one by one. And at this point, we're going to go back up and look at the question. Now that we know what they want, we'll see if there's information that we need to pull out of the question as we work our way through. So Canyon Canoe Company has experienced rapid growth in its first few months of operation, has significant increase in customers renting canoes and purchasing t-shirts. Many of the customers are asking for credit terms. Amber Wilson, owner and company manager, has decided it is time to review the business transactions and update some of the business practices. Her first step is to make decisions about handling accounts receivable. So far, year to date, credit sales have been $15,500. You'll see I made that bold already. That is an important piece of information that we're going to need as we work through the percentage of sales method down below. So credit sales, again, 15,500. And then the last piece of information provided to us in the question is an outstanding receivables listing, so an aging schedule. What an aging schedule is, for those of you that need a refresher, it lists all your customers. Here you can see they're listed alphabetically. And over to the right of the customer name, it shows how long ago the sale was made, essentially. So anything in that first column, 1 to 30 days, is considered a current receivable. And that means that we made that credit sale to that customer within the last 30 days. Most companies expect payment somewhere between 30 and 60-day time frame. So we tend to see the age listing split into 30 to 45-day chunks. So 1 to 30 days, 31 to 60, 61 to 90, and then over 90. What we have down in the bottom corner here is the total accounts receivable balance at the end of June before any adjustments. So we add up what all of our customers owe us, and it totals the 3120. All right, so moving into our requireds. The first required we have wants us to use the percentage of sales method, assuming 4.5% of credit sales will not be collected. So again, if we go up to the question, our credit sales, we already bolded up here as being 15,500. When we estimate bad debt using credit sales, we're going to take bad debt expense as 4.5% of credit sales. In this case, 4.5% of 15,500 to get a total estimate for bad debts of $698. So pretty easy. Requirement number 1, percent of sales is just a straight calculation, taking the percentage, multiplying it by the credit sales as given. Percent of receivables method is a little bit different. With the percent of receivables method, what we're really trying to do is come up with a target balance for our allowance for doubtful accounts account. Okay, so the target balance in this case is going to be 22.5% of the accounts receivable balance. If we look up above here again, we'd highlighted on our age listing, total accounts receivable at June were 3,120. So 22.5% of 3,120 gives us the target balance for AFDA. So it doesn't give us our bad debt expense yet. It just gives us that target balance that we want in that account at the end of the period. So our bad debt expense, to drill down another layer, is actually the target balance plus or minus any amount that's already sitting in the allowance for doubtful accounts. The question told us that there was a zero balance in allowance for doubtful accounts to begin with. So in this case, we just have a straight calculation. Target balance of 702 minus a zero balance to start in the account gives us total bad debt of $702. What I've done off to the side here is I want to show you the T account approach to calculating the allowance for or the bad debt expense when you're using a percent of receivables instead of a percent of sales. So the T account approach, we're going to start with an opening balance, which in this case they've told us is zero. And what I'm trying to do here is come up with that target balance that I want at the end. So the 702,000 representing the 22.5% times 3120 is in fact the target balance that we want in our allowance for doubtful accounts account at the end of the period. So we start with nothing. At the end of the period, we would like to have a balance of 702. So the question then is, what do we need to record to come up with that target balance? And that ultimately ends up being your bad debt expense. So for example, if we had a credit balance in the account of $25,000 or $25 to start the period, our target would still be 702 based on 22.5% of the receivables balance. But in this case, you can see bad debt expense, instead of being 702, would be 677, because we're going to take that ending balance and subtract off a balance that already existed in the account. Okay, so hopefully that's clear. In this case, as I said, we have a zero opening balance, so we end up with 702 as our bad debt expense. Okay, so that's 1 and 2. I'm just going to close those off so we can see number 3 here. All right, for number 3, we're using the aging of receivables method, and we're assuming 5% of invoices over 1 to 30 days won't be collected, 20% of the next column, 40%, and 75%. So before we get into doing the calculation, just want to give you explanation of why those percentages increase as the account becomes more aged. So the assumption is the longer an amount remains uncollected, the less likely it is that it will be collected. So for example, this early start daycare, we don't have any current sales to them. The last sale we made to them was actually over 90 days ago. So the longer we take to collect that money, the less likely it is, in theory, that we will collect it. Okay, so we can see our current receivables, we expect to collect most of those, and as they become more aged, it's less and less likely. Okay, so we're going to fill in the amounts. Doing straight calculation, 5% times the 1900 to give you 95, and so on and so on and so on, to give us a total then of $689. And again, what this represents is the target balance in your allowance for doubtful accounts. Okay, so we have that target balance of 689, and again, we have a starting balance of 0. Therefore, the bad debt expense for the period is going to be, and just to not confuse the issue, we'll make it a different color. Okay, so our bad debt expense is the $689 under this approach. All right, moving on to requirement 2 and 3 now. They want us to journalize. Whoops. Close this one. Okay, journalize the entry at June 30th, 2021 to adjust bad debts using the percent of sales method. So the percent of sales method was A up above here. So I'm opening it up for us to see. We came up with a bad debt expense of $698. And remember, to record the bad debt expense, we use two accounts, an income statement account called bad debt expense and a balance sheet account called allowance for doubtful accounts. So we debit our expense, we credit our contra asset account for $689 each, and that entry is to estimate bad debt expense. And that's all they want for requirement number 2. Number 3 wants us, let's close these off again. Number 3 is taking a look at this account here, the early start daycare. We talked earlier about it being an old receivable. So we made this credit sale over 90 days ago. So the likelihood at this point of collecting is getting a little bit questionable. So the company, in fact, has said, you know what, we're not going to receive payment from early start daycare. So let's clean our books up. Let's take that customer right out of our register and record it as an uncollectible amount. Okay, so what we've got then on June 30th is a debit to allowance for doubtful accounts this time, and a credit to accounts receivable. So by crediting accounts receivable, we're taking early start daycare right off of our listing. Accounts receivable is an asset account. Allowance for doubtful accounts is a contra asset. So to take a look at this note over here, what this entry does is it cleans up our register by removing early start daycare. There's no change to the overall net receivables. Remember, net receivables or net AR equals accounts receivable minus allowance for doubtful accounts. So if I'm taking receivables and lowering it, but I'm also taking allowance for doubtful accounts and lowering it, the net receivable doesn't change. Okay, so that's how we do a write-off, which takes care of requirement number. Okay, so requirement number 4, we're opening T accounts for accounts receivable and allowance for doubtful accounts before the journal entries that we posted in requirement 2 and 3. So the first thing we want to do is set up our opening balances for these two accounts with the information that is known from the question already. And we know our balance in accounts receivables at June 30th from up above here is 3,120. They've told us that the balance is 0 in our allowance for doubtful accounts. So we'll start with journal entry number 2 above. And if we look here, we have a debit to bad debt expense, income statement account. We're not doing a T account for that one. And we have a credit for allowance for doubtful accounts. So we're going to put that credit in to the account. Remember, credit's on the right, debit's on the left. And the second thing that we need to do is post our journal entry from requirement number 3. So we have, again, an amount for allowance for doubtful accounts. Was a debit balance this time, so debit on the left of $500. And the write-off to accounts receivable ends up being a credit in our accounts receivable accounts. Okay, and this gives us ending balances in those accounts of $26.20 and $198. That's all that requirement number 4 is asking of us. So essentially, this is like making postings into the general ledger, and the final line here is your balance then, your adjusted balance at the end of June 30th. The final requirement is, okay, now that we've done all this, how will Canyon Canoe Company report the net receivables on their balance sheet? Okay, so we know with a balance sheet, we need a 3-line title with the company name up top. Balance sheet, I've written partial in here because we're not doing a complete balance sheet, and the date at which the balance sheet was completed. Okay, so we have our headings. Receivables is an asset. More specifically, it's a current asset. So if we're doing a classified balance sheet, it will be under the current asset heading. We have accounts receivable in the gross amount, which we're taking from our T account here. And we're subtracting off the allowance for doubtful accounts from our other T account. Okay, so accounts receivable, gross, less allowance for doubtful accounts. And notice we don't have to say total account, net accounts receivable. We can just put our line and have our total over here. So that's how it will be displayed on the face of the balance sheet. And that is the end of the requireds. Hope you enjoyed. Thank you.